Okay, let's just get right into this. You're probably sitting there thinking, if I started investing in 2026, this is exactly what I would do. But look, if you're working with a smaller salary and just scrolling on your smartphone, I totally get why it feels incredibly overwhelming right now. There's just this endless sea of noise, wild hype, and honestly, really confusing jargon out there. But what if you could just skip past all those classic beginner traps? In today's explainer, we're going to lay out a super clear, step-by-step blueprint. And this isn't just theory. It's based on over 40 years of real-world investing experience. We're going to strip away all the nonsense, all the complexity, and show you exactly how to build wealth from the ground up.
So we can actually distill this whole complex world of investing into a really manageable 4-step process. First up, platform and account setup. Second, the 3-fund portfolio. Third, making your very first investment. And finally, number 4, knowing exactly when it's time to sell.
All right, step 1, platform and account setup. Let's make sure your chosen platform has FCS protection up to £120,000, has super low fees, and is genuinely easy to use.
Now, when you actually go to sign up, the app is going to ask you for 4 things: a photo ID, your national insurance number, proof of your address, and, yep, a quick selfie. Now, I know, a lot of beginners feel like this is super invasive and they kind of freeze up, but you actually want them to ask for this stuff. Jumping through these administrative hoops is standard practice. It's literally the ultimate sign that you're dealing with a safe, strictly regulated financial platform. Honestly, if they didn't ask for your ID, that's when you should be worried.
Here's the thing though, not all investing accounts are created equal. If you open a general investment account, sure, you can buy and sell shares, but you're going to get hit with capital gains taxes on your profits, usually around 10 to 20%. Ouch. But a stocks and shares ISA, that's a tax-advantaged account. You can contribute up to £20,000 every single year into it, and any profit you make is 100% tax-free. You could literally grow a portfolio to over £1 million and pay zero tax on those gains. So for a 2026 start, the ISA is an absolute no-brainer. Moving right along to step 2, the 3-fund portfolio. Instead of trying to outsmart the market by picking single stocks, we're going to use a brilliantly boring, low-fee strategy that grows steadily and helps you sleep through recessions. To really get the strategy, we have to understand what a fund actually is. I like to think of it like a giant basket filled with lots of different companies. Instead of stressing out trying to pick individual winners, buying this one basket gives you a tiny piece of ownership in all of those companies at the exact same time. It's instant diversification. You can own a slice of massive companies like Apple, Amazon, and Coca-Cola, all with just a single investment.
Okay, so the core of this strategy is having 3 of these baskets: a U.S. stock fund, an international stock fund, and a bond fund. But that brings up a really crucial question. How do you actually split your money between them? Well, there's no magic one-size-fits-all answer here. The exact split between those 3 completely depends on 2 things: your age and your personal risk tolerance. Let's break down how different people handle this.
For example, let's look at the typical split for an older investor. Notice that massive 40% chunk dedicated solely to bonds. Bond funds are essentially like lending your money to the government. They promise to pay you back with a little extra interest. They're way less volatile than stocks, and they really help smooth out the crazy ups and downs of the stock market. If you're older and you're relying on this money for retirement, you want to protect the wealth you've already built. That's exactly why they rely so heavily on the stability of bonds.
Now, let's shift gears. Look at a young, moderate-risk investor. The allocation completely transforms. Bonds shrink down to just 10%. Meanwhile, U.S. stocks jump to 55%, and international stocks take up 35%. Why? Because this investor is younger. They have a much longer time horizon. And having decades ahead of you allows you to lean heavily into the long-term growth potential of the global stock market, while just keeping a tiny bit of stability on the side.
And finally, we have the young, aggressive investor. 0% in bonds, none. It's entirely split between U.S. and international stocks. Now, I know that might look reckless at first glance, but here's the fascinating truth. When you're young and you have decades to stay invested, you have the time to simply wait out historic market crashes. In fact, if you have a massive time horizon, it's actually riskier to not take those calculated risks early on. All right, step 3, making your first investment. This is it, the exciting moment you transition from just watching the market to becoming a part owner of the most powerful companies on the planet. So, you open your app, you hit that buy button, and immediately you're hit with all this confusing jargon: market, limit, stop, and stop limit orders.
Day traders use these tools to tightly control execution speeds and prices. But here's the secret that will instantly lower your stress. As a long-term investor building a 3-fund portfolio, you really don't need to worry about most of this. A simple market order, which basically just says, hey, buy this right now at whatever the current price is usually the only order type you'll ever need. Over decades of compounding, a tiny price difference on the Tuesday morning you bought in, it simply won't matter.
Now you might be thinking, but wait, a single share of some of these tech giants costs hundreds of pounds. How do I even start if I don't have that much? Well, enter the magic of the fractional share. This is a total game changer. It allows you to invest based on a specific cash amount rather than having to buy a whole share. So, if a company like Tesla is trading at over $400, you don't need $400. You can just punch 100 pounds into your app, buy a fraction of that one share, and boom, you're officially in the game.
And why is it absolutely crucial to just get in the game early? Just look at this number, £525,000. Based on historical data projections, if you can manage to consistently invest just £500 a month into a solid strategy for 20 years, your portfolio could potentially be worth over £500,000. That is the incredible motivational power of starting early and just staying consistent.
Which brings us to step 4, knowing when to sell. Almost no one talks about an exit strategy when you're a beginner, but holding on to a stock out of blind loyalty, that will cost you dearly.
You absolutely need a clear exit strategy. Generally, there are 3 logical strategic reasons to finally push that sell button. Number 1, when momentum is dying and the internet hype is fading out. Number 2, when you genuinely need the capital for a much better real-world opportunity, like buying real estate or starting your own business. And number 3, when the broader market fundamentals have just permanently shifted against the company you're holding.
I really want to zoom in on that first point for a second. Momentum always fades eventually. It's not a question of if, it's just a matter of when. If a stock is shooting to the moon purely because influencers are pumping it and everyone's making memes about it online, that price is incredibly fragile. We saw this exact thing happen with companies like Lemonade Inc. Once the reality of their fundamental business issues set in, the price just completely collapsed. Please, do not fall victim to that toxic diamond hands internet culture. If you see your stock surging purely on hype, that is exactly when you should consider selling a portion to lock in your profits.
But for your core, beautifully boring 3-fund portfolio, this classic quote has to be your ultimate North Star. Time in the market beats timing the market. As a long-term investor, time is literally the only variable you cannot fake. The math behind compounding doesn't care about your emotions, it doesn't care about the latest news cycle or opinions or short-term panic selling. It only responds to absolute consistency. The people who win this game aren't the fastest and they usually aren't the smartest. They're simply the ones who stay invested.
Which brings us to the final thought for today's explainer. Are you ready to trust a simple system long enough for time to actually work in your favor? Because if you can stop chasing the hype, set up your tax-advantaged account, build your 3-fund portfolio, and just let it sit there for decades, well, you're already using the exact same strategy that builds quiet millionaires every single day. So, start your 2026 investing journey with confidence, trust the process, and let time do the heavy lifting for you.